very good morning to everyone. I'm Akanksha Joshi, and on behalf of Mergerware, I take this opportunity to welcome our featured panelists and audience to this exclusive webinar on the extremely pertinent topic, M&A execution in 2022, perspectives from the legal experts. Mergerware is delighted to have with us today some very notable industry leaders who are experts in their field and shall be reflecting on the theme of this webinar. Let me begin by introducing our panelists and moderator for today. We have with us today Devin Scaffer, Vice President, Corporate M&A and Venture Capital at Cardinal Health. Devin joined Cardinal Health in 2015 after spending 7 years in private practice. During his time at Cardinal Health, he has supported the M&A function and served as General Counsel to CAH's Canadian subsidiary. Devin currently leads a team that supports M&A, corporate governance, securities, indirect procurement, information technology, real estate, EH&S, and CAH Foundation. Coming to our next panelist, Ismail Alsheik, who is the Senior Vice President, General Counsel at Vantage Data Centers. Ismail is responsible for leading and setting the strategic direction for the legal and corporate compliance function for Vantage Data Centers globally. He is a respected leader with more than 16 years of experience as a corporate lawyer, the last 5 of which have been focused on the data center industry. Prior to joining Vantage, he was a partner in the Mergers and Acquisitions Group of Jones Day, where he advised clients on transaction, corporate law, and corporate governance matters. Our next panelist today is Jared Bachynski, partner at Stikeman, Elliott LLP. Jared practices in Stikeman, Elliott's Corporate and Securities Group, and he's based in Vancouver, BC, Canada. His practice is focused on mergers and acquisitions and other corporate transactions, often with a cross-border element. His clients include public companies, private equity firms, and their portfolio companies, as well as entrepreneurs and startup companies. We have Zach Brecheisen, partner M&A at Jones Day, as our next panelist. Zach is a corporate lawyer who focuses his practice on domestic and cross-border M&A, as well as general corporate and transactional matters. He has experience representing public and private companies and private equity firms engaged in acquisitions, divestitures, joint ventures, corporate restructurings, and related commercial transactions. Zach also counsels clients in a variety of general corporate governance matters, including takeover defense and fiduciary duties. He has advised domestic and international clients in a broad range of industries, including energy, mining, manufacturing, heavy metals, cosmetics, and broadcast technology. We also have with us Russ, Vice President, Corporate Development at Ansys, who will be moderating the panel today. Russ is a deeply experienced corporate development professional with specific expertise in strategy development, M&A, investments, and post-merger integration. He manages global M&A activity at Ansys Inc., the worldwide leader in engineering simulation software. Prior to joining Ansys, Russ served in a similar role for 12 years on SAP's global corporate development team, negotiating and managing M&A and strategic investment transactions of all sizes, from multi-billion-dollar deals to small IP acquisitions. A very, very warm welcome to all of you. I would also like to request the audience to feel free to share any questions that they may have for our panelists in the Q&A box, and we will make sure to take them at the end of the session. So, well, let's begin the day. Over to you, Russ.
Thank you, Akanksha. Greetings, everyone, and on behalf of our panelists, thank you for tuning in today. It's a pleasure for me to be moderating a discussion with such an esteemed group of panelists here. We have 4 highly experienced M&A professionals with us. I know you're going to walk away from this webinar with insights on what's happening in the M&A market and with information to help you manage your deal activity in this environment. What about this M&A environment? Well, We are in the midst of a record-breaking run of M&A activity that began in the latter half of 2020, in spite of, and in many ways because of the impacts of COVID-19. And during the course of this M&A era, many of the deal dynamics that we have become accustomed to have changed and continue to evolve. For example, competition for deals has dramatically increased. Employee retention following deals has become more challenging. We've seen the rise and more recently the waning of special purpose acquisition company or SPAC deals as a means to IPO. And we've seen greatly increased regulatory scrutiny on deals across the globe. During the course of this session, our panelists are going to help us make sense of all of this and more. So I will stop talking now and get into the discussion here with our team. Zach, let me first start with you. Can you tell us a few things that buyers, both strategic buyers and financial buyers, are doing to land and protect deals in an environment that is highly competitive as well as, frankly, seller friendly?
Sure, Russ, and maybe just as we kick off here, I wanted to thank the Mergerware team for bringing this group together, and to you, Russ, for assembling the panel and moderating here. I'm happy to be here and glad to talk with everyone today. Russ, I think you put a great sort of primer there in terms of the market, super seller friendly market that we've seen over the past sort of year and a half. I think, folks are expecting that to continue as we roll into 2022 in earnest here. The underlying dynamics that were pushing that, are sort of still present. We've, despite, I guess, headwinds that are kind of gathering a little bit on the horizon, right? That the regulatory changes you mentioned, uncertainty around that, sort of uncertainty around what COVID's going to do, around what's going on with inflation and potential, at least here in the U.S., sort of tax policy associated with the Build Back Better legislation. So again, the fact that the market, despite these sort of uncertainties, is just going forward at full speed still, I think is really great for us and for everyone listening in here. So a couple of things that sort of, assuming, you're looking at like a private target here, a competitive sort of auction, a hot asset, right? Things that we've been seeing buyers do to distinguish themselves. First thing, is rep and warranty insurance. This is nothing new for anybody. I think on this panel or tuning in, we've had rep and warranty for years and years here, but I think we have seen, given the seller-friendly dynamics, that a buyer needs to be prepared to obtain a rep and warranty policy, if they want to distinguish themselves, because that's standard operating procedure in the PE world. It has been for years now, but I think that's extending into the strategic M&A world as well. Strategic buyers like strategic sellers like PE sellers, a lot of them are looking for a clean exit. They don't want to be tangled up in potential exposure or liabilities post-closing. And so again, we'll see in auction scenarios, sellers coming out saying, hey, our expectation is buyers are going to come here with a rep warranty policy, or you guys are going to have to get comfortable with potentially going naked on sort of reps and warranties. And that's not only just pushing whether or not people are getting policies. I think it's, and we can talk about this later as well, but it's pushing sort of the actual terms of the policies themselves, right? In normal times, you might see sellers and buyers splitting retentions or policy premiums 50-50. Everyone has a little skin in the game. I think these days you're seeing much more of buyers being willing to take 100% of both, and sellers in many cases insisting on that. And then sort of other things that buyers are doing to distinguish themselves is the typical type of stuff you would expect sort of in a hot competitive auction process, right? Buyers really need to demonstrate, their ability to close with minimal conditionality. So that means sort of submitting their bids with fully committed financing, papers attached, especially for strategic bidders, demonstrating that their internal and external advisors, are nimble and deal savvy and can move towards execution quickly and sort of the back end closing as well, and streamline the due diligence process. So again, picking up from sort of the nimbleness that a lot of times we more associate with financial sponsors. Again, that's more becoming sort of across the board for strategics as well. And then we'll talk later about sort of, as you mentioned, Russ, some of the regulatory risks, buyers' willingness to assume some of the incremental risk there is something that buyers have been using to set themselves apart as well.
Excellent, thanks, Zach. And I should mention here, as was apparent by the intros, we've got represented on our panel here 2 external counsel from large law firms and 2 in-house practitioners who manage their M&A activity from inside of their respective corporations. So Ish, on behalf of the internal view, I want to get your take on things that buyers are doing and what they could and should be doing to protect their deals in the current environment.
Yeah, sure. So certainly agree with what Zach said. I think rep and warranty policies were sort of an exotic instrument that wasn't used always. But when it came on pretty strong. Just thinking back to my career, I worked with your colleague, Patrick Belville, on a deal for a private equity sponsor named Quintana in 2011. They acquired 2 plants from First Energy. They subsequently flipped them in 2014. And we were on the sell side then. It was a deal where, our private equity investors basically said, look, there's this product called this rep and warranty policy, and we want to get out of this clean. At the time, we had to sort of educate the buyer about it. I mean, fast forward to 2022, as Zach said, it's every single banker process letter, right? There's a sentence in there that says, no indemnity, anything you want is purely going to come from a policy. I will tell you now, at sort of the bleeding edge of taking on even more risk, what we're seeing is no rep and warranty policy, because that does take 7-8 days to line up if you have relationships with brokers. So even that small time delay, if it's a really hotly competitive auction, you might be able to get away with simply saying, as the buyer, we will do limited diligence, we won't even get a policy. And then what they try to do to sort of get some coverage is you try to get the sellers to do a bigger rollover. And you sort of say to yourself, well, how stupid would they be if they're keeping, 40% of their proceeds in the business if there is some major problem with it? They're basically destroying a significant chunk of the wealth that they would extract out of this deal. Now, that being said, the big rollover kind of disadvantages your bid. So it's really just, your sort of game theory as you go into the bid. All right, what can I do that makes me, able to get to signing super quick? Sometimes management sort of knows that if anyone acquires them who's a sponsor, there's going to be a rollover anyway. So, they're kind of less concerned about it. But that's what we've seen is, no diligence or very limited diligence, foregoing a rep and warranty policy, obviously foregoing an indemnity. Zach made another great point about fully committed financing. We've seen more, full equity backstops than we've ever seen before, where the buyer, sort of says, look, we'll stand behind the whole thing. $600 million deal, we've got it. And, basically the theory being, we'll just arrange bank financing right after we close, such that, it won't be any of your risk between signing and closing. We'll be able to get to closing, faster than anyone because we don't have to negotiate that with a bank. And then that comes with a whole bunch of other benefits, right? Then you don't have a reverse termination fee, which you would usually have, because if you're taking out bank debt, there's the whole song and dance of, all right, is it a $5 million, a $10 million, a $50 million break fee? Well, if it's a full equity backstop, you just get the specific performance. Now, obviously, as the seller, you've got to do a little bit of diligence and make sure they've got the 600 million, right? Because specific performance against a vehicle that doesn't actually have that money, or that can't call that money from its LPs. So then it goes into sort of how much diligence do you want to do? If it's more of a smaller to middle market PE shop, they might be more forthcoming. if it's one of the larger ones, they'll say, go pound sand. It's, like we're a $5 billion fund. We're not going to show you anything. You just have to sort of trust us. And that becomes a little bit of a tense discussion where, your banker as the seller sometimes advocating for the buyer, as can happen from time to time. Not to dismirch bankers. I love bankers. So
I'll do that on your behalf, Ish.
Say that again, Russ.
I said I'll besmirch bankers on your behalf. It's fine.
Yeah. Spoken like a true corp dev guy, right? And then the last one I would just say, and Zach, I know you touched on this and said we'd address it. So, typically when we, have done deals, in East Asia, particularly China, there might, where if there's, regulatory issue, there's sort of a no fault break fee. And that's kind of creeping into more M&A in the West, where, it's just sort of like, look, if there's anything that gets, we don't think anything's going to get in the way of this deal. We don't think there's any material antitrust, risk here. But if there is, we'll wear it. We'll give you a chunky fee. We don't think it's going to happen anyway. So those are, it's sort of just buying as many days as you can to try to, paint a picture for, the seller that, look, I don't even need exclusivity. I need a week and, or even a couple days. And I think I can get this done. To try to distinguish yourself as a buyer.
Thanks, Ish. Really great insights from both you and Zach, and to all of our banker friends out there who may be on the line. Just kidding, guys and gals. I want to come back to, you both mentioned RWI, and I do want to double click on that and get into more specifics about what's happening in the RWI market. But before we go there, Devin, let me turn to you. Another dynamic that I know buyers are struggling with these days is on the topic of employee retention following deals. And key employee retention has always been critically important in M&A deals long before the environment we're in now. But retention is much more difficult now. This is an employee-friendly environment driven by intense competition for talent. And COVID has made, employees change their views about things like work location and work-life balance. And so, Devin, can you share your thoughts on some ways that buyers can better ensure good employee retention following a deal?
Sure, Russ. Appreciate it. It's to your point, this has always been a key issue. And frankly, I think the retention piece is more of a ordinary course, running the business consideration, because when you are, buying a company, you always want to ask yourself, are there key people that we need to retain to run this asset effectively? I think the next question is, do those people own meaningful equity? Because in many instances, it's difficult to get someone excited who's receiving double-digit millions for, even a really nice retention payment. What I've seen in the M&A context is more transparent discussions around whether or not you actually need those key people to run the business. Because what I've seen in the past is, you may throw a decent amount of money at someone, but there's this kind of tacit understanding that, they probably will leave after a year or 6 months. And I feel like there's more of a focus on, do we really need these people? Is this retention enough to keep them interested? And I've actually, for the first time, heard people say, you know what, I'm not really excited about moving forward with this transaction because of those dynamics. Either an individual owns, meaningful equity, or, they just feel like we just can't give them enough to keep them interested. And I also think that you can also bucket these in two buckets. So from a PE perspective, Ish mentioned rolling over equity, and I do think that is a really effective tool. I mean, because you align incentives there. But speaking from a strategic perspective, we're not always a big fan of having minority shareholders in a public company. So that's not a go-to for us. So I think there's some limitations there. And so, I mean, I guess I would close by saying that it's really that consideration of, do we need these key people? Can we keep them interested? If we can't, then we really need to be honest about our ability to move this thing forward in a positive way.
Yeah, thanks for that, Devin. And I would say, you know, as a corporate development practitioner, you know, that's something that I try to do, is bring those transparent discussions forward among the business teams. You know, they're difficult and sensitive discussions to be had, but they're important ones to have. I want to double down on the in-house, you know, strategic view on this, because employee retention is important long after the deal has closed to the acquirer. So Ish, anything to add on this topic to what Devin said in terms of what you guys are doing or what you're seeing, or what you think is valuable from an employee retention perspective?
Sure. You know, coming from the PE standpoint, we love rollovers. I mean, it's like a major part of our model. So, you know, big distinguishing factor between the large, you know, public companies and the PE shops and the PE owned companies. You know, significant rollover of equity is becoming pretty standard. You know, a big point there is to try to sign up the term sheet for the rollover at the signing of the deal. You know, once you've signed the deal, you know, that the bankers, when they're selling the deal, when they're running the auction, they'll sort of say, look, no way, we're not agreeing to anything. You know, you can't be bugging our management, you know, delaying the deal. Well, you know, surprise, surprise, you sign the deal, and then now, you know, the sell side, you know, gets their own lawyer separate from deal counsel, and, you know, they're just fighting you on every single point. So, you know, our experience has been, you know, you're going to take, you know, a decent amount of risk if you don't have that term sheet at signing. So important to push for that. You know, I think to Devin's point, you've got to figure out who is critical to the deal. You know, even if you're doing very limited diligence on anything else, you do need to figure out, if you're going to do the rollover, who needs to roll, and zero in on the couple execs where it's really important. And then, you know, the ones where it's less important, you know, yeah, they might be getting a few bucks out of the deal, but, you know, they might not be as needed anyway. And they candidly, they might be happy to work unless they're getting like a truly outsized sum. And like, to be clear, you know, I talked to my friends on the West Coast about this, like, how do you keep people who got this big payout? I mean, their answer is just pay them more and more and more, right? So don't pay on them, dump stock on them. And you'd be surprised, right? Like, you know, you thought your $11 million payout was great, but, you know, you could work a little bit more and get the plane, right? Convert your NetJets account to you know, a full-time plane on the tarmac. You'd be surprised, or you know, the hardwood basketball court in the house, which you know, to my mind is probably, you know, almost equally as cool with the jet. And then the other thing is, you know, give those guys sort of humongous upside if you can. You know, the other thing is a big delayed signing bonus, right? That they're not going to like that. But sometimes you don't need someone forever, but you'd love for them to be there for a year to kind of transition. And so you can say, look, you know, we really want you to stay on, you know, at least for this year. We'll give you this delayed signing bonus. You know, earnouts, you know, people have different sort of views on them. If you forfeit the earnout, if you quit, I think, you know, then you get into issues of the earnout being taxed as ordinary income. So that's a little bit less attractive. But look, I mean, you know, when I was at the firm, we had clients that insisted on earnouts in every single deal. It worked well for them. As I always say, the only two people in the world that like, you know, earnouts are like divorces. The only people that like it is lawyers. Because basically they get fought over every time it comes to whether or not you pay it. And if you don't have to pay it, you know, they're going to dispute you on it. But look, we have, you know, we know people where they make the criteria very, very tight, and it's a good way to kind of, you know, hold them back in. And then you try to get creative with it, right? Like if they leave, you can kind of figure out, like, if you're leaving for a good reason, then this happens with your equity. If you're leaving, because you're quitting for convenience, then we buy it back, and we buy it back with a note, and it's on unfavorable terms. So, there's sort of no limit to how creative you can be, but I think it's usually some mix of, rolling over if you can, and some delayed upside if you can. And that seems to be a pretty good method to, keep management, kind of locked in after a deal.
Yeah, thanks for that. Thanks for sharing. A lot of levers to pull there. So let me come back to the topic of RWI. Jared, let's get you involved here. What are you seeing in the market? Yeah, certainly RWI is prevalent. It's made the RWI market hot for insurers. So there must be some impact. I know there's impact on pricing, coverage exclusions, availability of policies. Talk to us a little bit about what you're seeing on those things and other specifics around RWI.
Thanks, Russ. And, I think from my perspective, the story of rep and warranty insurance really took off in Canada 2014, 2015. And until last year, it was always a buyer's market, and almost extremely so. The terms were really favorable. The policies were your dream contract. If you could write any insurance policy, that's what you'd actually get. Exclusions were minimal, and if there was anything, you could usually negotiate out of them by just doing a little bit more diligence. And pricing was, I think, a little higher in Canada than in the US. Or maybe we felt it was higher than it should have been because we're less litigious up here across the border. But overall, it was a great product, sort of a resounding success where everyone involved in the transaction could just take a body of risk and sell it to the insurers. And everyone was really happy about it. And I think what we found this year is we were bumping up against some limits, and it's finally transitioned, certainly in the back half of last year, into a little bit of a seller's market. And I think that was just, at least in part because there was a giant traffic jam and a limited number of skilled underwriters available. So the insurers not only had the ability to be selective, they had to be selective because they could not do every deal that was coming in front of them. And I know Zach and I traded some notes. He's got some good notes on some of the specifics, but just a few anecdotes in my experience. Towards the end of last year, we were getting people saying flat out, no, we cannot do your deal until 2022. Like, don't knock, like your deal's too small. We've got enough 9-figure deals to do. Don't come talk to me with an 8-figure deal if you want to close it in 2021. Or just indications that they would do it, but we had to get in line. And it wasn't, the typical story where insurers were the only people on earth who worked harder than investment bankers, and they would get it done in 36 hours notice. They'd say, we can do it, but we're gonna need a couple weeks. You got to get in line. And I personally saw a couple transactions pivot from insurance, and the LOI stage was insurance. And the buyer said, well, if you want to close this year, should we just go back to a seller indemnity? And it was accepted. And so I saw deals going back from insurance. So my insurance broker friends who may be listening in, apologies to you. It's still a great product. We're going to keep using it, but definitely saw some, for the first time in my career, change in the overall market dynamics for buying this product.
Yeah, thanks for that, Jared. Zach, let me, I know you've got some thoughts and want to share what you're seeing. So let me have you jump in here.
Yeah, sure. No, and agree completely sort of with Jared and what you were laying out there. Q4 of last year was just crazy, right? We basically had to get, you said get in line. We were having to basically, schedule our underwriting calls like weeks in advance just to get on the underwriter schedule, right? So we could sort of, maintain our little 2-hour block in time and not get bumped off by somebody who had more urgent needs. So it was just wild. And overall last year was just, huge amount of volume in the RWI space. And sort of, as you said, Jared, that increased volume with the limited number of skilled underwriters who created its own sort of dynamic in terms of issues, right? And I think that also happen to overlap with the changes in the market in general as it relates to RWI. You know, a lot of claims being paid out now from policies issued years ago, some real kind of headlines, sort of large, severe claims. You know, all of that sort of contributing together with the increased volume to drive up premiums, particularly here in the US, and then, you know, sort of lead to a situation where, you know, insurers and underwriters are kind of painting with a broader brush from an exclusion perspective. We saw a lot of this kind of at the end of last year. Again, you know, these underwriters, they're people, you know, they only have but so much bandwidth. So, you know, you may see insurers pushing for sort of these broader exclusions instead of the more sort of nuanced, surgical, sort of tailored exclusions that are more sort of, you know, tailored to an individual particular liability or issue that was uncovered in diligence. So for instance, you know, you might get sort of a broad exclusion for all state tax returns. For instance, if you're a company that sells products sort of throughout the US, as opposed to actually, you know, a tailored indemnity, or sorry, a tailored exclusion that just looks at sort of the individual jurisdictions where there's actual real risk there. You know, you've got other situations, you know, misclassification of employees is always sort of a, you know, a touchy spot with insurers. But I think we saw as we were getting into the end of last year that, you know, if there was even a whiff of misclassification issues, they would say, you know, standard exclusion, you know, we're just carving it all out, even though, you know, it only may be a couple areas of sensitivity that were identified in due diligence. So again, painting with a broad brush there, I think is sort of what we saw. And then that also includes, you know, there are just now standard exclusions that you're going to see in pretty much any policy, and insurers are just not really going to move on them, you know, for COVID, for obvious reasons, right? The uncertainty associated with that, and then sort of any losses or damages associated with like CARES Act or other sort of COVID relief funds or programs that a target might have participated in. And then we've seen some pretty broad exclusions on supply chain disruptions in general. Insurers don't seem to want to touch that stuff at all. It's just given, again, the uncertainty and sort of the potential for that really to rack up some big claims. I'd also say too, and you know, it's kind of a backdoor exclusion here, but the insurers were a lot more aggressive and continue to be more aggressive on deemed modification to the reps and warranty language in your merger agreement or SPA. You know, just kind of taking a kitchen sink approach, right? So when I refer to deemed modifications, I mean, you know, they'll say in the policy, like anywhere notice or claim is used anywhere in a rep, you know, we're going to assume that that's written notice, or it has to be written claims, right? Or, you know, sort of generous sprinkling of knowledge qualifiers throughout reps that, you know, a seller might, in just sort of a normal transaction, be willing to sort of go with the flat rep, right? So again, a lot more aggressive approach with respect to some of those deemed modifications, you know, and actually, you know, it is kind of good, at least from that perspective. A lot of the insurers have been upfront with that at the NBIL stage, so it does give you an opportunity as a buyer to kind of pre-negotiate those a little bit while you still have a little bit of leverage. But as Jared mentioned, you know, the insurers themselves seem to have quite a bit of leverage, you know, as things came down to people racing to try to hit that 12/31 mark. So it just, I don't want to take too much time on this, but the other thing is I do want to mention sort of an overall added scrutiny of the due diligence process that buyers and their advisors are going under. You know, the underwriters are taking a lot more harder look, making sure that proper DD is being done. And from my experience, I've seen a lot of emphasis on cybersecurity and data protection lately, particularly for industries or targets that traditionally have not been sort of a high risk area from a data protection standpoint. You know, just run-of-the-mill manufacturers, commercial, you know, product manufacturers, things like that. We're not even talking about, you know, folks in the defense industry, defense contractors, or you know, companies that may collect a lot of personal information. You know, we're talking about your run-of-the-mill folks. You may end up spending 15-20 minutes of a 2-hour or less underwriting call focused just specifically on the DD that was done on data protection. So that's something I think buyers, you know, and your advisors need to definitely understand, that they're going to take you through the ringer on that one if you've not done your due diligence there.
Thank you both. And I think, you know, the takeaway from all these changes that you guys have discussed, for me as a corp dev practitioner, is you got to have somebody on your external legal team who is expert in RWI, helping you navigate all these issues. They're changing so rapidly, just from deal to deal. What you got on your terms in one deal 6 months later has changed, turned on its head. And you need somebody who is, out there in the market seeing these changes as they come continually. It's big help. We've talked about two areas in RWI and on the topic of employee retention that have changed over the last few years, but have been around for a long time. Let's talk now about two newer phenomena that's really come out of the last couple of years. And I'm referring to obviously COVID-19 and the impact that has had on deal making, but also on environmental, social, and corporate governance. A lot of attention spotlight is on that area in the normal course of business, but obviously as well when you're acquiring a company in a new business. And so, Devin, let me turn to you. Can you describe how you're seeing ESG and COVID considerations impacting the deal approach, due diligence approach? For example, maybe what are some newer, non-obvious questions that you're seeing, or you think buyers should be asking in these areas?
Yeah, I'll start with COVID and then talk a little bit about ESG. I thought the reactions that I began to see to COVID were when you look at the MAC clauses, you had everyone adding in this COVID exception. I thought it was a bit of kind of false precision because you would say if COVID causes X, Y, Z, then we can get out of the deal, but we're in the midst of COVID, so it's like, what's the reference point? Are you referring to something that happened like 6 months ago, or is this something that would allow us to stop a deal from signing? So I would be interested to understand whether or not anyone ever, actually leveraged the COVID exception to the MAC clause. So as far as, that was pretty much the extent of what I saw from a deal perspective. It was more of putting language in the documents. You argue back and forth over the exception being too broad, and some people wanted to incorporate the fact that we've already made progress on COVID. So definitely a lot of man hours spent on that provision. With EH&S, it's ESG, it's definitely all the rage, especially at the public company, from a public company perspective. But when I think about M&A, it doesn't really change what we're doing unless we were looking to pivot into something that is completely different than what we are doing today. Because when you think about our ESG structure, it's a corporate governance led effort, and so we currently cover all the issues for our business as it stands today. So whether you're thinking about environmental or the social aspects or governance, we have a proxy. We have all that information out there. Now, if we were to pivot and do something that deviates from what we do, that has some implications there, then from an M&A perspective, then people would be laser focused on it. But considering the fact that when you're doing acquisitions, you're typically doing tuck-ins or buying things that are adjacent to what you're doing currently, it's not the biggest deal from an M&A perspective. And I know that Jared shared some notes, and I'm really interested to hear how people are getting after that from the private perspective. But as I think about it, our due diligence, legal due diligence list hasn't changed because we're not worried about a board structure, because the board will be, we won't have a board. We'll have a board, but it'll be our treasurer on the board. It'll be a subsidiary to the mothership, if you will. And so all of those things just kind of take care of themselves.
Thanks, Devin. Jared, let's get your perspective, and maybe with respect in particular to your private company clients. What are you seeing? How has ESG and COVID considerations changed the approach to diligence?
So two thoughts on this, Russ and Devin. One is we have seen ESG focused investors making some more moves in the market. So they've obviously, just in terms of selecting the investment, there is a dynamic in the market where there's some investors who are looking specifically for investments that are overall positive from an ESG perspective. And we're also seeing all sorts of investors, not just ones that have a focus on, an ESG investment thesis, asking us to apply an ESG lens to our diligence process and our work product. So we've seen some clients, both in terms of growth equity investments and private equity investments, asking us to report separately on ESG as part of our firm's diligence work product. So we'll I think address overall similar issues that we would have been addressing in past years, but we'll present it and we'll think about it in such a way to make sure we're asking questions around things like climate change, for example. Has the business been affected by climate change? Do they have a plan in place for climate change? And what with the news we've been seeing the past few years with fires and floods and structural issues with buildings, our clients are now asking us, make sure you're drilling down on this from a legal diligence perspective to help us evaluate, is this business appropriately considering and doing risk management around climate change risks? And from a social perspective, that even on the private company side, people are looking at things like pay equity, board diversity, D&I initiatives, and certainly drilling down still on any instances or allegations of harassment, because people are still focused coming out of the Me Too movement on any sort of inappropriate behavior. And we're still seeing that in the news, the impacts of people really focusing on having a perfectly a real awareness that there's reputational consequences, and there can be HR consequences, even and leadership consequences of inappropriate workplace conduct. So when we get a hint that there's been allegations of this, that our clients ask us to really focus on it, so there can be a full understanding of any allegations as part of the diligence process.
Excellent, thanks, Jared. I'm doing a time check here, and we're in just about our last quarter of the session. And so I just want to take maybe just 2 minutes. I mentioned at the outset, and most people familiar with deal making have heard in the last couple of years their share of about SPACs and SPAC deals. Things are starting to change there. And so if I could just quickly ask first you, Zach, and then Jared, come back to you. What are you seeing in the SPAC market, and what are some things, if there's anyone on the line thinking about a SPAC deal, either an advisor or private company themselves, anything they should be aware of that's different from a traditional IPO or M&A deal? Just if you could just take a couple of minutes. Zach, you first.
Sure. Thanks, Russ. I'll be quick on this. Just, in the US at least, huge volume of SPACs sort of early 2021, but has since sort of coasted a little bit in terms of the actual IPOs. I think going into 2022, you have a lot of SPACs out there that are still looking to de-SPAC or sort of do a private transaction on the back end. So there's a lot of hunger looking for, targets right now, and that'll continue into 2022. As if someone's sort of looking at that as kind of an exit, or a target company potentially looking at that to sort of raise capital. I mean, one of the unique factors is sort of the shareholders of the SPAC, their redemption rights. Ability to redeem if they don't, if they just want to get their money back basically and not sort of go along with the invested company. That has lately sort of ballooned the redemption rates. in late 2021 and continuing now in 2022. So again, that just sort of adds uncertainty if you're looking at this as an option, in terms of certainty of closing on the transaction. I'll also note, kind of to play bad cop a little bit, at least in the US, SEC is sort of honed in on these quite a bit. The SEC guidance is kind of still in flux, and there's also kind of a heightened risk of litigation around SPACs right now because it is kind of a bit of a recent flavor. SEC's brought a bunch of high-profile enforcement actions recently against SPACs and their sponsors, and the SEC has also been issuing extensive comment letters on disclosure, particularly around conflicts of interest with the sponsors or the target company's financial projections. And then, wherever the SEC is sniffing around, the plaintiff's bar is going to be pretty close behind, right? So, an increase in sort of plaintiff suits against or actions brought against the SPAC. So again, pointing things out that may sort of add to an element of uncertainty here, some added risks and things that you may have to think about post-closing potential exposure. But yeah, I'll let Jared start off there.
Yeah,
Zach,
thanks, Jared. Over to you.
I'm just going to say, Zach, great overview and completely agree with what you said. And what I'm watching in 2022 is how the sort of tech unicorn market and the SPAC market continue to dance with each other. I think that was a big part of the story last year was the tech SPAC IPOs, and certainly what has been the early result of that has been a little bit underwhelming in terms of post de-SPAC performance. There's a couple of big transactions that have been announced in 2022. So I'm thinking of MariaDB and D-Wave out of Vancouver, which, full disclosure, our firm's involved in, so I won't comment further. But sort of we may have a couple of bellwethers for people testing to see what can still be done here. Because I think, notwithstanding the fact that there's been some softness in the market, we still have these two market forces that I think are going to result in some interesting deals getting done, which is a lot of dry powder and SPACs with a timetable associated with it. So for people who are looking to do a deal, the capital's there, and there's going to be a deal to be done. So that's got to be tempting from a negotiation dynamic perspective. And then on the private capital side, I was reading some stats. I think there's something like 900 plus venture funded unicorns right now, and they're all looking for an exit. So there's going to be some willing partners here, and it's going to be interesting to see what deals get done and how in the market this year things will play out, notwithstanding the dynamics that we all saw in the second half of last year.
Thank you both for that. Let's turn to the topic of regulatory scrutiny. This is certainly something that's affecting every cross-border deal, but even domestic deals, and wherever they're located, there is a tightening up of the scrutiny on M&A activity. I see it in tech, but it's in other industries, particularly those that have been very active since COVID. Ish, what are you seeing? What's playing out in your world, including in the areas of antitrust and foreign direct investment? Share a little bit about what you're seeing from your perspective.
Yeah, sure. So I think that, I mentioned kind of earlier, in light of, I think some of the regulatory issues and how unexpected it can be and unpredictable it can be, you're seeing more of a regulatory break fee if sort of anything gets in the way of a deal. Another big thing is, rollover affecting kind of joint control analysis and making sure to figure out, particularly where, a selling fund is staying in, what that means in terms of where you have to file, who controls, whenever you talk to a global antitrust lawyer, the answer 100% of the time is it depends. Facts and circumstances, you've got to go through the indicia of control. And look, I mean, the fact of the matter is you go to jurisdictions like Europe, it's just super heavy regulation, sometimes, a little bit opaque, tough to understand. So you sort of do the best you can, but can be sort of difficult to wade through. There used to be this concept of people investing in like non-voting shares that flip to voting, or investing up to the HSR threshold and then buying the rest later. People, what we're seeing is people are tending to kind of move away from this, particularly given, the Biden administration and, the new folks that are sort of doing these reviews and how aggressive they are. There's this real sense that, if we do something that doesn't pass the smell test, that looks like we're basically trying to structure around having to file. People are just, doing a lot less kind of, I'll just be cute and try to see if this kind of gets by. I think people are sort of realize that some of those things might come with some risk. The other thing we're seeing is a lot more people filing, on an LOI. This used to be a little bit more exotic. A few years ago, you'd see it, but typically you sign the agreement and then file. We're seeing a lot more, look, let's file as quickly as we possibly can, get the LOI on there and sort of start the clock, particularly during COVID, where you just didn't know, pre-COVID, so many deals sailed through 14 days, you get your, you basically get your approval, and we're sort of no longer in that world. Zach, kick it over to you in case you've got anything to add.
Yeah, please, Zach, go ahead.
Yeah, no, agree completely there, Ish. And a lot of the things I think that you're noting sort of they flow to a couple of things, right? Sort of the volume, right? And the fact that particularly it's still being a seller's market, people are pushing, to get things done quickly. And so that's why, as you said, filing off the LOI, but now that early termination is sort of, the suspension of that started again last year, it is taking some of the optionality and some of the remedies off the table. And you mentioned sort of the Biden administration, they've been in the White House for about a year. They've got their picks sort of in at the DOJ and the FTC. There's a lot of hellfire and brimstone kind of talk out there about how they're going to really sort of drop the hammer when it comes to antitrust review. I think at least, anecdotally, it doesn't look like sort of the actual level of enforcement activity has sort of caught up to that rhetoric just yet. But again, recognizing it's only been a year, there's, there are guidance and updated policies that are still sort of making their way through the regulators. So I think 2022 may be, we may get more clarity from that perspective in terms of how aggressive they're going to be, at least on the antitrust front. And then that feeds into the sort of the deal negotiation, right? Who's going to bear that risk? How's that going to play in terms of negotiation around, the covenants themselves, and then remedies, as Ish has said mentioned a couple of times around break fees. I will also mention that, again, sort of this wave of deal flow has had some issues in terms of, like with the RWI market, underwriters trying to keep up with the volume. I mean, same thing at the DOJ and the FTC, right? There's limited numbers of folks there and resources. And that's why we saw sort of the suspension of early termination, but also, sort of this unique back, I think it was August of last year, the FTC started issuing some of these things called sort of pre-consummation warning letters, which were basically, sort of the FTC throwing their hands up and telling, parties like, hey, we've got this 30-day HSR clock. We're not done with our review. Close at your own risk, guys, but we are still, as regulators, reserving our rights. We can still come back even after you guys close and render a determination here and potentially assess remedies on the companies. So that introduces a whole sort of legal issue of like, well, have the necessary closing conditions been met? Like, does this letter constitute sort of clearance, or if I'm a buyer, I'm going to say, no, we we're not in the clear here, seller. You can't force me to close based on this letter. So again, just sort of the stopgap measures and sort of the movement there, particularly on the antitrust front, is just sort of creating issues that folks didn't sort of initially think about when the easier world when it was a little more black and white in terms of negotiating some of these provisions and the shift in risk. But I also want to be mindful of our time, so I'll probably leave.
Yeah, just quick follow-up, Zach, on that last point you're making about the less than helpful letter on antitrust. You see that causing a lot of parties to pull their filing and refile in the hopes that with another 30 days, they'll get around to it.
That's the typical sort of remedy, Russ, was that, if, the sort of the back channel communication with the regulators, if they need more time, you pull, refile and restart the clock. I think some of the pressures and the timing dynamics created last year, you did have some companies just say, you know what, we're going to go ahead and do it. We'll take our chances. But yeah, that still remains sort of a potential remedy. But again, it sort of depends on the timing concerns too.
Jared, before we move off this topic, maybe in a minute or two, anything to add from the Canadian market perspective on the regulatory environment?
I'd just say that what we're seeing in sort of global politics, I think, is something that is worth bearing in mind in a deal in terms of Canada's national security review regime. Any deal where there's a Canadian target is potentially subject to a national security review. And historically, there have been extremely few such reviews. I think maybe only a couple that have ever resulted in a transaction being undone. But recently we've seen certainly in the news that, like with the recent Neo-Lithium acquisition by a Chinese company, there was a lot of coverage about why was the government not digging in on this? Isn't lithium strategic? And you can see how political pressures and commentary of this process could change the dynamic for people when we're dealing with certainly Russia or China or other regimes where you can see there's potential conflict globally. So I'd say more so than perhaps in recent years, I think that buyers and sellers are going to have to consider the national security review process in Canada, depending on what players are involved.
Great, thanks for that. I'm looking at the time here. This has been a really great discussion. I think we covered a lot of ground. I want to be sensitive to any questions that may have come in. And so, Akanksha, I'll turn it back to you. But before I do that, I just want to say again, thank you to this all-star group of panelists here, Mergerware, to you for sponsoring the event, and to all of you out there attending. Appreciate you taking the time for us today. So, Akanksha, with that, let me turn it back over to you.
So that was indeed a really interesting discussion. So thanks a ton, Russ, for moderating the panel. Also, a big thank you to Devin, Jared, Ismail, and Zach for the amazing discussion. I'm sure that this has piqued our appetite and leaves us wanting for more. So very special thank you to our audience for attending today's webinar. We hope that you found it informational and insightful and found value in hearing from such a diverse set of industry experts and deal makers. We will also be sharing the recording of this webinar with all our attendees. So again, thanks everyone, including our guest speakers and audiences, for attending today's webinar, and have a fantastic day ahead.